morning to all our clients and other business owners. A warm welcome and thank you for joining us in yet another of our complimentary monthly business webinars. Now, our business webinars have become extremely popular with well over 100 people joining us every month. So why not introduce our complimentary webinars to a business friend of yours? They'll thank you for it. So my name is Monique Charland and I'm the founder and the CEO of Business Accounting Network, which is a national franchise of professional accountants and chartered accountants, tax and business advisors through Gauteng, the KwaZulu-Natal, the Free State and the Western Cape. And we've just celebrated our 20th year in business earlier this year. Now this morning, we are going to address the question, what is more important in business, profit or cash flow? And what is the difference between the two? Not many small businesses have experienced really good economic times over the last 12 years or so, but there have been good economic times. Then South Africa hit a recession before COVID-19, and many small businesses were battling even before then. Not many businesses remained unscathed during the lockdown itself. And now it is most likely that South Africa is heading for a depression. And we are talking about a subject of cash flow and profit in your business. So whether in good times or good economic times or bad economic times, the principle on which the basis of success in any small business or any business for that matter does not change. And that is profit. Profit and cash flow is a static concept in business. And although we as accountants have tremendous compassion for the hard times bestowed on many of our clients and small businesses generally, this information session to follow forms the very foundation of a successful business. And as you will learn, profit and cash flow have no sympathy for hard times. I'd like to introduce you to our presenter today, Belinda Schmitt, who is a professional accountant and a franchisee of Business Accounting Network. And she's been a franchisee with BAN for the past 18 years. And she's based in the northern suburbs in Cape Town. Belinda obtained her BCom degree in 2001. And her many years of experience in BAN, working with business owners across a wide range of services, has given her unparalleled knowledge of the industry today. So without any further ado, I'd like to introduce you and hand over to Belinda. Warm welcome, Belinda.
Super. Thank you, Monique. Thanks for that lovely introduction. Welcome, everybody. I hope you're going to enjoy the session with us today. It's only an hour long, and I hope you're going to find the next hour quite informative and actually take your business and the guidelines that I'm going to be discussing to the next level. Super. So if we're all ready to start, I can start on the presentation. So Shane, just before we start, I'd like to gain a general idea of who our audience is today. Could you perhaps run the first poll that we discussed, please?
Okay, I'd love to. Thank you, Belinda. Right, folks, the first one that we're going to put up is, the question is, do you understand the difference between profit versus cash? There we go. We've got 89% have said yes. Okay.
Wow.
So okay. I don't know if you have any comments on that one.
Absolutely awesome. This is going to be very easy then. But you're going to know exactly what I'm going to talk about.
Yeah.
Awesome.
Do you want me to run the second one at this point? Or
that will be wonderful. Thank you.
And Monique, I know you'll be pleased to see the high participation rate. That's fantastic. Let me close and share the results. On 84% participation in the field, we've got the majority, 71% say yes, I do and understand. 22% yes, I do, but don't understand. 8% no, too complicated. So I think it looks to me like there's a lot of people brushing up today on this course. Yeah.
Okay, awesome. So thank you so much for that. I appreciate your feedback, and I think I'm going to be talking to the 22% that gets their cash flow, but they don't understand it, or it's actually too complicated. I really hope that for that 30%, I'm going to maybe shed a little bit of light on the subject just to help you to better understand what is being presented in front of you. So awesome, thank you. So without further ado, shall we go? Great, so we all know that we're here today to discuss the difference between cash flow versus profit. Right, so we all know that cash is the lifeblood of any business. If you have a good business model and you are great at managing your cash, your company will be wildly successful. The common mistake many small to medium-sized business owners make is to focus on profits alone. A business cash flow is equally important. No profit means no cash flow. And cash flow is important as every business needs to pay expenses, repay bank loans, pay taxes, and even purchase new assets. This is where the understanding of profit versus cash flow comes in. So, what is profit, you might ask, and how does this differ from cash flow? Well, understanding this difference can make it easier to know whether a profitable company is a good investment, number one. And understanding this relationship helps in making important business decisions, which includes the best way to pursue growth. Let's take a brief look at what the differences are. Profit. Profit is the amount that your income exceeds the expenses you incurred to earn that revenue. This can result in a positive net profit or a net loss. So a net profit is where your sales exceed your expenses. A net loss or a negative is where more money was spent on operating than being able to recoup via sales. Profits can be distributed to owners or shareholders via a dividend or reinvested back into the company to purchase new inventory or those much needed asset purchases. It is important to note that profit is on paper and is by no means a reflection of actual cash in the bank. For example, inventory can be purchased on credit from your supplier. A sale can be made on credit to a customer. This sale, less any direct cost incurred, is reflected on your income statement, but doesn't represent any cash movement in your bank until the customer has paid for his product he bought and you have paid your supplier for the inventory purchased. So profit, once again, is on paper and not money in the bank. Let's have a look and compare it to what the actual cash flow is. Cash flow is the movement in your bank balance from the beginning of the month to the end. This movement can result in a positive cash inflow or a negative cash outflow. A positive cash inflow is money coming into the bank, for example, via sales and debtors' receipts. A negative cash flow is money flowing out of the bank, for example, via inventory purchases, paying of expenses, paying of loans, or taxes. A positive cash flow is actual money in the bank. Cash flow is therefore a timing difference between payment for a product you've purchased for resale and actually receiving the money for that sale. One should always try and have enough cash in the bank to physically pay expenses, which includes payroll and other operating expenses, plus paying yourself a market-related salary and investing in future growth. There are three main categories of profit, which I'm sure you, as a business owner, are very familiar with. These are gross profit, operating profit, and net profit. I'd just like to briefly go through the difference between each of them. Right, gross profit. Gross profit is sales. Sorry, I think I should just go into get rid of that. Okay. So gross profit is sales less cost of goods sold, which includes both direct and variable costs. Operating profit refers to the net profit a company generates from normal business operations and excludes interest and tax payments. This is often referred to as EBIT, or earnings before interest and tax. Net profit is the overall result after all expenses have been deducted from sales. Now, when we look at cash flow and the cash flow statement of a business, we can identify three main sources of cash. These are operating activities, investing activities, and financing activities. I will explain these a little bit later on in the presentation. It is important to understand your cash flow. So keeping records of all the cash coming in and going out of your business is critical. So often the question is asked, we are making money, so why is there no cash in the bank? The answer to this is understand the concept, profit versus cash. So how does one manage cash flow? One obstacle to business success is how you think about money. Ask yourself this question. Do you start from a position of scarcity and fear or one of abundance? Why is this important? If you operate from a position of fear, you will tend to avoid dealing with critical financial issues until you absolutely have to. It is best practice to rather deal with money issues up front, early, and often. Be upfront with your clients and suppliers about what it takes to separate money from their wallets before doing any work. For example, ensure that there are proper payment terms in place with your customers in the same way you have payment terms with your suppliers. The key is to receive cash from your customers before you have to pay for expenses. One needs to use clients or customers as a funding source instead of them using you as one. One of the biggest mistakes is to take on low profit, demanding, or even bad paying clients just to get money through the door. One needs to start optimizing collection and pricing strategies and manage expenses. Accept only good money clients and adopt smart and timely billing policies that minimize the amount of time providing services and receiving payment. This mindset is critical to being great at managing cash flow. Let's pause for a minute to think about how much gross revenue you actually need to get the cash to buy something. This is break-even. Do you know what your break-even is? What is break-even? Break-even is the minimum amount of sales you need to make to be able to cover all your expenses, or the minimum number of units that need to be sold in order to cover all costs or make a profit. At this point, your total cost will equal your revenue. This is the point where a business will neither make a profit nor a loss. The aim is to exceed this point so that you can make a profit, which is important for the growth of a company. Knowing your break-even point might make you think twice of how to generate more turnover or revenue. If you are short on turnover, you are short on profits. Increasing turnover will enable you to cover those critical expenses every business has. Calculating Your break even is something your accountant can assist you with. The general formula for this is total overheads divided by a gross profit percentage. Now that we've covered the general differences between profit versus cash flow, let's try and understand cash flow. To reiterate what we have said earlier, profits. There we go, profits. Profits are what shows up on the bottom line of your income statement. In other words, have you sold your services or products for more than it costs to deliver them? Remember, this is profit on paper and not money in the bank. My fellow colleague Isel Sneeman gave a presentation on the 16th of September on costing your products. If you weren't able to attend the presentation, I really would encourage you to listen to this recording, which can be found on the BAN website under client free webinars. Cash flow. Cash flow, on the other hand, focuses on the timing of when your company gets paid and when you have to pay someone else. Operating cash flow. This is the cash generated by your company's normal operations. There are three critical areas we need to take into account when looking at the operating cash flow. These are inventory, debtors, and creditors. The relationship between these three is important as they reflect the timing differences between when inventory or stock is purchased from your supplier on credit, when a product is sold to a customer on credit, and when you finally get paid by your customer, and then when you pay your supplier. Free cash flow or reserves. This represents the amount of cash your business generates less any capital expenditures. One would generally use the free cash flow to repay debt, reinvest in your company, pay out dividends to owners or shareholders. Every business should aim to generate free cash flow because this is what creates wealth for you, the owner, and generates money so that you can grow your business and replace those vital assets in your business. It is therefore important to understand your cash flow is the timing of when cash comes in and goes out of your company. This is usually different in the timing between when an invoice is raised for a product sale to a customer and the customer pays you, or when you receive an invoice from a supplier for inventory purchased on credit and when you pay your supplier. Your business can be making a profit, but still have a negative cash flow. So why is this? Well, regardless of the amount of profit you made, if the amount of cash you receive is less than or equal to what you spend, then you are eating into your reserves. This will negatively impact your ability to pay your suppliers and in turn impacts on your ability to operate. Okay, we're going to go into a little bit more of a technical slide. But before we start this, Shane, can I maybe ask you please to run the third poll?
Okay, sure. I'll just come in on the webcam for that. So folks, this is the third poll for our session this morning. And the question is, do you receive a cash flow statement with your management accounts? And please select one of those options. Yes, I do. No, I don't. Yes, but I don't understand it. So there is a bit of a proviso to that yes. Either yes or yes, but I don't understand it. Once you select one of those three options and submit, please. Closing the poll on 85% participation. Thank you for participating. There we go, Belinda. We've got 54% have selected yes, 10% yes, but I don't understand it. So that's a total of 64% yes, 36% no. Back to you. Thanks.
Okay, awesome. So thanks for that. Great. So 54%, okay, that's middle of the road, 36% and the 10%. So I'm really going to be chatting to you guys, and maybe after you see what an actual cash flow statement looks like and why it is so important, you're going to encourage your accountant or your band franchisee to actually include this in your management pack for you. It is one of the most critical things that you do need to look at to make your business grow from strength to strength. Okay, so what we have here is a basic example of what a cash flow statement looks like and what it should contain. A cash flow statement is generally a summary of your bank statement presented in a specific format. In other words, it's a summary of whether there was an increase or a decrease in your cash flow after a month's worth of trading. That is why we've got it divided month to month to month, because you want to see what your cash flow is doing month after month after month. You want to see whether your company has been able to generate cash, okay, which is going to be in this line item here. So the cash flow statement is a reconciliation of your beginning and your end bank balances. So really the movement. It is a detailed map of where the business income comes from and where it goes, which makes it a very useful tool for day-to-day operations. Right, so the amounts depicted in brackets, if you can see my cursor there, this represents an outflow, okay, negative outflow, while the opposite in no brackets is income, positive cash coming in. As we mentioned in our previous slides, there are three principal sources shown in this cash flow statement. Cash flow from operations, cash flow from investing activities, and cash flows from financing activities. Right, so one would normally start, with your net profit as depicted in your income statement. Add back any non-cash flow items, for example, depreciation. This will give you a net profit after non-cash flow items, or EBITDA. This is earnings before interest, taxes, and depreciation. This is a measure of your operating cash flow. So after the calculations, we will look at this line. What is it generating there? A positive or a negative from operations. Now we look at operating cash flow, operating capital, to see where and how the money was spent. This will show us the cash generated from cost of sales and normal business operations. A positive cash flow from this is required to maintain business growth. For this, we need to look at your balance sheet, taking into account the movement of three main items this month in comparison to prior month. The three main items is your inventory or stock, your debtors, customers or trade and other receivables, and suppliers or your trade and other payables. Let's focus on trade and other receivables, debtors collections, and inventory purchases. It is critical to not only see the revenues as recorded in your income statement, but also the actual amount of cash you collected from those sales. Most larger businesses use the accrual basis of accounting. As a result, revenues and the actual collections of those revenues are reflected in the financial statements in different periods. Looking at your balance sheet, accounts receivable figure this month versus prior month. If your debtors increased from last month, this means that you have made more sales on credit than actual cash received. this will result in a negative. Okay? So just wanting to reiterate, you have made more sales on credit than actual cash received, so you're not getting the money in the bank yet, so it results in a negative cash outflow. The same principle applies to inventory. The timing of the recording of cost of goods sold in your income statement is different than the recording of actual inventory purchases. The analysis of actual cash received for goods sold or products purchased can be seen in this cash flow statement. For example, if inventory has decreased from last month, this means that more stock was sold than purchased, so it results in a positive cash flow. Positive cash flow there. More inventory was sold, results in money coming in, positive cash flow. Right, now if we look at the line item trade and other payables. If this has increased from last month, that means that you have purchased products or services on credit, and this has ultimately saved you cash. This results in a positive cash flow. So the cumulative result of this or these three items here, represented in this line item, will either give you a cumulative positive cash inflow or a negative cash outflow. Right, now if we look at the investing activities, this reflects any net cash generated from a company's investment-related activities, such as physical purchase of assets or sale of assets. Any purchase of assets results in a negative cash outflow, and any sale of fixed assets results in a positive cash inflow. In healthy companies that are actively investing in their business, this number will often be in the negative. The final line item to evaluate how your cash was spent is by looking at the financing activities section. All financing activities relate to non-current liabilities. For example, were there any loan repayments? Your installment sale agreements, have you made payments on those? This will result in negative cash outflow. Or was there a cash injection into the business from a member or a shareholder? This would result in a positive cash inflow. This line item is a reflection of how cash moves between investors or owners and reflects the net cash generated to finance the company, which includes debt, equity, and dividend payments. Right, so adding all the above line items together, one can see whether there was an overall increase or a decrease in cash during the month and where it came from or how the money was spent. An ultimate positive cash flow occurs when the cash funneling into your business from sales or accounts receivable is more than the amount of the cash leaving your business through accounts payable, monthly expenses, salaries, etc. A negative cash flow occurs when your outflow of cash is greater than your incoming cash. This generally spells trouble for a business, but there are steps you can take to remedy the situation and generate or collect more cash while maintaining or cutting expenses. Right, so why is cash flow statement important and what can we learn from it? If you really look at your cash flow statement, you're missing key information that can help you run your business more effectively. Reviewing your cash flow statement can give you many insights into the health of your business. For example, a cash flow statement can reveal, is your business attractive to investors or lenders. Many investors prefer businesses that consistently generate a lot of cash. It ensures that they will get their dividends. Banks look closely at the financing section of your cash flow statement to see how you have handled loan payments in the past. Do you have excess cash available that could be better used? Sometimes a business has excess cash on hand that could be used more profitable by purchasing equipment or other assets, or just by moving it into an interest-bearing account. Are you carrying too much inventory? Excess inventory costs money to store. Improve your cash flow by maintaining appropriate inventory levels. Are your customers taking too long to pay? You can shorten the payment cycle by following up on an overdue payment immediately, offering discounts for early payment, and invoicing right after a job is finished. Are you taking too long to pay your suppliers, and why? Are your operations generating enough cash in the long term? In a healthy business, cash flow comes primarily from operating activities. Your business may appear to have a healthy net income based on the income statement, but the cash flow statement reveals whether most of the income is from loans or putting personal money into the business. Your core business operations need to generate the majority of your cash for your business to be sustainable. Is your business at risk of a cash shortfall? Review trends in your cash flow statements to spot potential problems. For example, what if you need to buy lots of inventory for your busy season, but won't recoup that outlay until the products sell? So now you can see that your cash flow statement is a window into the health of your business. Use it properly and see how your business grows year after year. Right, so in conclusion, let's look at a few basic and important guidelines on how to improve your cash flow. Calculating your gross profit margin. As a business owner, you should all be aware of how to calculate your gross profit margin and understand the concept of what this percentage means. Understanding this margin will highlight, for example, when you need to increase your prices on which products and services. Increasing your prices at the right time and on the right products and services could have a positive impact on your cash flow. Implementing some form of job costing to track the true costs to deliver a service or product will also help in achieving your target gross profit margin and improve cash flow. The biggest value of job costing is knowing that nothing has slipped through the cracks and you are getting paid for all the value you deliver. This, of course, also includes understanding the true labor costs that are associated with a product or service provided. Number 2 is monitor your days sales outstanding. You need to reduce this figure to the smallest possible number. This ratio means the number of days it takes to collect at least R1 of your sales. If your average debtors days outstanding exceeds your average credit terms with your customers, then your business is more likely to struggle with cash flow. Knowing this ratio can help you to determine whether you need to improve your current processes and policies. This is something your accountant can assist you with to highlight cash flow weaknesses. Consider advance payments from customers. Receiving an upfront payment on every job will immediately change your mindset of scarcity to one of abundance and immediately limit your risk of non-payment and legal fees associated with these debt collections. So why, do you ask? Well, many jobs target at least 50% of gross profit percentage. So by receiving this upfront, you will have already covered your costs at the start of the job. Getting paid in advance is the way to avoid situations where you need to chase clients that delay payments. Upfront payments allows owners to pay for the direct costs associated with products or services. Bill weekly instead of monthly or milestone billing. When a retainer or weekly billing won't work for your type of business, milestone billing is the next best thing to help stay cash flow positive through the course of a large project. This is the key to give you enough working capital to keep investing in the next phase of your project. For example, through your planning, your design, your development, and ultimately implementation. Start with a mindset that you need to stay ahead of your direct operating costs. This means getting a large percentage upfront and receiving subsequent payments loaded into milestones. The goal is to leave the smallest percentage for the final payment when most of the problems arise. Bill immediately upon completion of a project. You should invoice your client as soon as possible or as soon as the job is complete. Don't wait for the end of the month to send out your invoice. If you focus on getting your money faster, you will be well on your way to improving your cash flow. The best part about cash flow maximization strategies of increasing cash inflows is to reduce receivable days, reduce inventory holding days, and pay your suppliers on time in accordance with credit terms agreed upon. Small changes can have enormous ramifications on your cash flow. Collection process. This is something everyone hates. Debt collection is always the last thing anyone wants to do, so often it really gets done well. The biggest mistake is to assign collections to a receptionist or an office manager, unless you have made it very clear where it fits on the priority list and allow sufficient time to do it right. A receptionist cannot make collection calls if he or she is also having to answer the phone. A cash flow mistake a lot of businesses make is to assign the task to someone inexperienced in debt collections and not allowing sufficient time for this time-consuming, stressful task. One option to improve this process is to have the salesperson be accountable for the collection process, or at least just get them involved. Review your collection dynamics. Send an email reminder or call your client at least 5 days before the debt is due. Frame it as a client service call to check on client's level of satisfaction, while also checking to ensure the invoice was received. Try and get a commitment as to when you can expect payment. Be ready to respond to any client service issues. Manage balances and credit rates on credit cards. Paying off debt that carries high interest rates can quickly improve your cash flow. Always pay your credit card bills in full every month. Credit cards generally have a very high interest rate on debit balances. A 20% interest rate on borrowed money will cost you big money per month. You should therefore prioritize every month to rather pay off your credit card as soon as cash is available. If you have a high credit card interest rate, rather use your overdraft facility, for which interest is charged for the actual number of days that you use it. Accept credit cards as payment. Small business owners often don't want to accept credit card payments because of the service fee, which could range between 2.5% to 3.5%. Making it easy for your customers and clients to pay you will help prevent cash flow problems of slow-paying customers. Credit cards are a great return on investment when compared to the distraction of having cash flow problems and the true cost of billing and collections. As a reminder to ensure you cost this expense into your selling price. In summary, let's focus on the 3 F's of collections. Be firm, be focused, and be friendly. Be firm. Get a payment date commitment out of your clients. Call the day before. And for example, say, we have you in our system for payment tomorrow. Can we count on that payment? Be focused. If your client gives you any feedback, listen carefully and address any concerns immediately. These actions will show that you are serious about high quality service and ultimately getting paid for that service. Be friendly. Always be friendly and provide the highest level customer service you can help them through the process and make it minimally stressless for them as possible. This will help the customer feel comfortable and eager to help resolve the late payment. Establish a written credit policy or terms and conditions. If you are not being paid upfront for your products or services, you are giving your customers a loan. I'm sure we didn't all get into business to be a loan officer. You need to do a credit check on each customer if you are allowing them to buy on credit. Don't underestimate the importance of this. In addition, you need to make sure that you have a written credit policy. This credit policy should include terms and conditions of your proposal or contract and referenced in your invoices. Very important, be sure that your clients know the details regarding the rules of your company's billing and collection practices before you start doing any work for them. At the very minimum, your written policy should include payment terms, late fees and how they will be dealt with, for example, when you charge interest on late payments, and legal fees on very late or non-payments. Just a precaution, when you start charging interest, your business will fall under the National Credit Act. So my advice would be to seek professional advice before starting this process. Review your expenses. Look at all your expenses line by line to understand if you truly need to incur each expense. Analyze how it contributes to new sales or retention of current clients. Look at all your overheads monthly. This number should not grow unless it has to. Your management accounts as prepared by your band franchisee will highlight this. Pay your suppliers on time. Only pay bills when they are due. Take advantage of discounts if available. And last but not least, experiment with your pricing model. As mentioned at the beginning of this webinar, the number one reason why businesses fail is because jobs or services are not priced right. How well you price your products and services and the margin this produces is key to maximizing cash flow. Your price should cover your direct costs and overhead and still give you a profit at the end of the day. So, how do you optimize your pricing model to increase your company's profitability? Well, that's easy. You turn to your management reports and look at the data. Your band franchisee will definitely be able to assist or guide you in identifying critical areas. So in conclusion, a monthly analysis of your cash flow status will help identify problem areas that need to be addressed and action taken in trying to maximize cash flow into the business. After all, cash is king and ultimately the lifeblood of a business. It is the fuel that keeps the engine running. Profits generate positive cash flow. Remember, you need enough cash to pay your employees and suppliers so that you can make goods. It is the sale of those goods that help generate a profit. But if you don't have the money to make the goods, you don't end up with the profit. So you really need to structure your business to have a positive cash flow if you want your business to grow and increase your profits. Awesome. So that concludes my presentation for today. I hope this information has been useful and will help you in becoming a master to your cash flow rather than a slave to it. Awesome. Thanks, everyone. Which accounting package has the best cash flow statements reporting tools? Xero seems to be the best, David. Well, in my experience, any accounting package can't actually give you a cash flow statement that will actually tell you where your money has been spent, what is bringing it in, and help you. The cash flow statements that the accounting packages will generally just give you a movement of how many suppliers you've paid, who has paid you. But a cash flow statement is just more than that. So, David, that's not something, in my opinion, it's not something you can just pull out of the accounting package. It's something that your accountant actually has to look at your management accounts, your balance sheet, and your income statement to be able to give you the correct figures to help you identify where your business's strengths and weaknesses are.
And also I'd like to add to that, Belinda, is that when the bank franchisees prepare management accounts, we highlight those cash flow areas in our notes to those management accounts so that the clients can actually see where their outflows are and where their inflows are and what they need to work on. Some of the weaknesses we might have picked up and some of the strengths we might have picked up. And that's something an accounting package can't do. So it does need an accountant and some human intervention to make the information more useful to the business owner.
Absolutely. Doreen has a question. Just wanting to turn to my example, which I actually don't have. Why is an investment income shown as a negative figure under operating activities and as a positive figure? Okay, so Doreen, it really depends on, as I went through, it depends on the movement in your balance sheet from one month to the next. So it really depends on under that investment income section, what has happened throughout the month. So depends on what it is. It could be a positive or it could be a negative. Obviously, mine has just been an example. So, one would have to look at the details before one can actually say why it's a positive or why it's a negative.
I'd like to add to that, Belinda. Doreen, the investment activities really identifies the movement in fixed assets on the balance sheet. So those fixed assets could be computer equipment, plant machinery, etc., etc. So when a business purchases a fixed asset in any particular month, that is going to be an outflow of cash. And you'll see that in brackets. The following month, they might decide to sell an asset, which will then represent an inflow of cash. So the investment that we're talking about is specifically fixed assets in a business, buying those fixed assets and selling those fixed assets. I hope that answers your question.
Okay, then we have another one from Fatima. Hi, what about getting in the foot of the door with customers and waiting for payment? Is it advisable to maybe wait for payment just to get your foot in the door with a customer? Well, that's always a little bit of a tricky one. One must never really wait for payment. If it has been agreed, your terms and conditions have been agreed with the client upfront. Waiting for payment, why would that be? And how long have you been waiting for the payment? So I would say that even from the onset, don't get into that habit or letting your customer know that you are okay with waiting for payment.
Yes, I agree with Belinda entirely there, Fatima. You know, if it's a new customer or whatever sort of customer, you need to treat all your customers equally in that respect. You know, you don't want your business turning into a bank and loaning money. That's not what your business is about. So I think you need to, in every business owner, needs to have terms, as Belinda mentioned, with regards to payment and when payment becomes due, and not to let that ride. If it's a new customer or a big customer, even more so. They need to get into a routine and a habit of knowing when you expect payment.
Okay, Rick, my accounting package includes sales revenue as income in the cash flow statement. As this not necessarily profit, is this correct? So in a cash flow statement, if the accounting package is including sales revenue, then it would be my understanding that you've actually received actual receipts that your debtors has paid you for those sales, which is then being recorded through your cash book as a inflow. I hope I'm understanding your question there.
Sorry, Belinda.
No, you go ahead.
Rick, I think this is definitely not a cash flow statement. Cash flow statement certainly does not include sales or revenue in the makeup of a cash flow statement. A cash flow statement begins with a net profit and basically the movements of investing activities, which is your buying and selling of your assets, your operating activities, which is the movement between what your customers owe, what you owe your suppliers, and any inventory that might have been purchased, and your financing activities. So this accounting package might call it a cash flow statement, but if it reflects sales or revenue, it's not a traditional cash flow statement, because that really doesn't have much to do with the cash flow itself.
Yeah, that's why I was saying right in the beginning, an accounting package cannot provide a cash flow statement as per the example that I've given. The accounting packages, they will call it a cash flow, but what it will essentially just show you is all your debtors' receipts. So it's most probably showing you that, but the wording between what an accounting package cash flow is and what an actual cash flow is a little bit different.
Yeah.
Awesome. Thank you, Sarah-Gina. Awesome webinar today. Thank you very much for that. Thanks, Belinda, Monique, Shane, for another interesting, well-presented, often not well understood. Awesome. Thank you, Johan. Much appreciated.
Monique, is that, do you want to add anything to that? That's your website there, www.ban.co.za.
If you go to free webinar under complimentary business webinars, you will see the history of all our webinars that have been presented over the last few years. And if there's any topic or subject that you want to refresh on, or you weren't able to attend and you're interested in it, you're most welcome to watch it. Our compliments.
Michael, thank you for an important webinar. Great to receive a refresher. Interest received on an investment account. Where will this reflect on the cash flow statement? From Jareen. Interest received on an investment account.
That would be reflected in your net profit. So your cash flow statement begins with net profit, which would include interest received.
You got a super thank you, Belinda, exclamation mark from Azelle. Many thanks, Belinda. That was very edifying from Rick. Thank you. Manny writes, and I think this is our last question for the session. As a non-financial manager, how often should I expect CFS, cash flow statements? Thanks, Manny, for that.
Well, Manny, ultimately, if you are receiving management accounts monthly, I would suggest a cash flow statement to go with that. If you are receiving it bi-monthly, then bi-monthly. But it is an important tool to actually see the movement on a monthly basis. So that's what I would suggest to you. just want to add there, management accounts is key. You know, a lot of business owners say, no, we don't need management accounts, which is maybe, you know, it's not the right thing, because how do you manage your business? How do you see what has happened and where you need to go to the next month? So receiving a set of management accounts is key to every business owner. It doesn't have to be every month, can be every second month, or even every quarter. But at least if you receive it, you will know where you need to take your business to. Super. Thank you, Shane. That was great.
Lovely. Thank you, Belinda. And yeah, I've just got a thumbs up from Jenna. All questions handled. So thanks, Belinda. Thanks, Monique. Thanks, Jenna, in the background. And thanks to everybody for participating. It's always a pleasure to host webinars for you guys. Look forward to doing that again soon. Take care.
Thank you very much.
Thanks, Shane.
Thanks.
Cheers for now.
Bye-bye, everyone.